Well, hello and welcome to the special edition of Modi 365, the FII View with me, Tanvir Gill. My guest today on the show is one of the largest foreign investors in India, Bill Maldonado, who's CIO Asia Pacific and Global CIO Equities at HSBC Global Asset Management, joins me from Hong Kong to make sense of India and the world. Bill, great to have you on the show. Thanks very much for taking out the time to speak with us on this special occasion. You're one of the largest investors in India. When another large investor like Aberdeen spoke of officially cutting their India exposure by 2%, it made the market nervous. What have you done with your India exposure in the last 3 to 6 months? What's the view on India right now?
Well, our view is a bit more positive, I would say. So for us, India, the overall market is on close to a neutral valuation. So we would argue it's neither overvalued nor undervalued. And the way we think about that, by the way, is on a profitability and valuation basis. So we need to think about not just valuation, but adjust that valuation for the profitability. But within the Indian market, there are many stocks which are very cheap and very profitable. And in particular, in the energy, materials, industrials and financials, i.e. the very cyclical sectors, consumer discretionary. The expensive stuff that's balancing that out is more on the defensive side, the consumer staples, pharma, other things like that. So for us, there's still plenty of opportunities, plenty of stocks that we like in the Indian market.
Right, Bill, but is there a tactical shift away from India in fund allocations into Brazil, Russia, China, which have been oversold markets? And is it not so much about India being expensive, but more about those markets being extremely cheap?
Yeah. Look, I think that's an interesting question. So I think following Mr. Modi's victory about this time last year, people, generally investors, got very excited, including us. It was a very important moment in history, I think, in recent history for India. And people got very excited about the market. And I think maybe a lot of investors came into India who hadn't been there for as long as we and other investors had been there. So maybe things got a little bit frothy immediately following the election. And of course, some of the reforms, some of the things that need to change in India are going to take some time to bring about. We actually think that the government is making very good progress. It doesn't mean that it couldn't do more. It doesn't mean that there's not more to do, but there's already been a good deal of progress. But clearly, for some people, it hasn't been enough. So maybe some of that froth has come off. But I think more fundamentally, the outlook for India remains very, very positive. Inflation's very clearly under control. Mr. Rajan at the central bank is doing a very good job. The Reserve Bank is pursuing a very prudent and extremely successful policy. I think investors internationally, at least, are very comfortable with it. I think Mr. Rajan has done a fantastic job since he arrived at the RBI, and our desire is for him to carry on doing as he's been doing. So I think there's probably some downside room available in terms of interest rates, but perhaps not as much as some people hope. That's still a positive for the market. I think having a very clear and very good functioning macroprudential policy is very good news for India. Currency stability and everything that goes along with that is very good news for India. So we're very positive about that.
Sure, Bill, but on allocations, post the correction, India is what, sub 15 times on forward price to earnings, which has historically been in the fair range, so to speak. When and what would you think would make India a compelling buy again? You know, do you think that another 10% cut from here, in taking us to about 7,800, 76 to 7,800, that range, would act as a strong support base for the index, that is? Or do you think that key policy measures like, you know, the clearance of the GST amendment bill and perhaps a possible rate cut could move the needle on allocations?
Well, for us, we're very bottom up. we're not trying to make big macro calls. For us, the macro is more of a risk management aspect. And I know that it's sometimes difficult for people to understand this. I think the assumption is that all managers work from the top down and allocate on a macro basis, but we're very, very bottom up focused. So for us, what would get us to allocate more capital to India would be more opportunities. And for us, what opportunities am I talking about? I'm talking about cheap but very profitable companies. So yes, corrections in individual names and sectors and in the market can make companies more attractive and bring them into our radar and allocate capital. Or it could be an improvement in earnings. And I think that would be very nice to see in India. If we saw a nice pickup in earnings, I think that would attract us and other investors to allocate more capital to the market.
Sure, but what about earnings? When do you see a recovery there? Because analysts expect that Q3 of FY16 there could be a turnaround. And if that's the case, then in anticipation of that event, wouldn't the market merit a buy now?
I think a lot of the reforms that the government is undertaking are very pro-growth, are very, very positive for the economy and the market. But I think you're right. I think there's been some disappointment amongst investors that all of those good things, all those good ingredients in the Indian economy and in the global economy haven't translated more into stronger growth. For example, the very low oil price hasn't really yet come through in terms of stronger earnings for corporates, and India is particularly sensitive to that. But we remain optimistic. There's always a lag effect with these things. It always takes time for it to feed through to the consumer, to feed through to corporates. And I think we're beginning to see the effect. So we've had the lag, we've had the conditions, the beneficial conditions like the oil price and the reforms, and I think we're going to see the improvement in earnings. So we're very positive.
Sure. Well, money has been chasing quality paper in India, so the defensives have done well where there is growth visibility. You've seen IT, pharma, FMCG, again, drawing interest. Where do you see opportunity in the market right now? What are your pet themes as far as India is concerned?
Well, I would say that theme for us is not a good theme. We don't like that. That's a very defensive theme. And the problem is that those companies have now been bought up to very expensive valuations. I mean, they're great names. There's nothing wrong with the names. They're great companies, well-run companies, but they're now very expensive. So for a similar level of earnings, let's say that those companies are delivering 20% ROE on average, 15 to 20% ROE. For those names, you're going to be paying 3, 4, maybe even 5 times book. Whereas if you look more in the financials, the cyclicals, so industrials, consumer durables names, you're going to find the same level of earnings, the same level of growth at a fraction of the valuation at 1 to 2 times price to book. So for us, that's where we want to hunt, that's where we want to look for exposure, rather than in the now very expensive quality names.
Hold that thought, Bill. We'll take a short break on that note, but when we come back, it'll be a lot of talk on emerging markets and how India's position ranks within that basket, as also the key global cues that one needs to watch out for. Welcome back. You're still watching Modi 365, the FII View, and I'm still in conversation with Bill Maldonado of HSBC Global Asset Management. Bill, there was a sense that India is well exposed to EM funds and Asia funds, but there is low exposure to global funds, which offered an opportunity of more money coming into the market. Also, sovereign wealth funds, they're looking at India. What is the sense on the street about fund flow patterns to India from especially the larger houses?
Yeah, look, I think that's a good question. I think we see a lot of interest in India. So in the past 6 or 12 months, we've had a lot of conversations with investors about India, both about the equity market and the fixed income market. There's a great deal more interest in Indian bonds than there has been ever that I can remember, certainly in the last 20 years. And I think there are people making allocations and getting ready to make allocations, sometimes for the first time. We've taken a group of investors over to India. They wanted to see for themselves the picture on the ground. They were in Mumbai, they were in Delhi, and I think they walked away with a very positive view. So I would expect allocations over the medium term and over the long term to pick up to India. I think that's absolutely right.
Sure, Bill. What about the currency risk? Because that's also a key variable when you look at investments across the region, not just for India, but world over. How do you monitor the currency risk with India? As an investor, what's your take on the rupee versus other emerging market currencies? Till 2014, of course, the rupee was the strongest currency. Now it's the second weakest to the lira. How do you see the currency trade play out?
Yeah, I'd say that weakness is very muted. I mean, we're talking about really very little weakness compared to some of the gyrations during the taper tantrums, if you remember that. I mean, we're really talking about much more muted range. And the INR is one of the more undervalued emerging market currencies now. Now, it's a much harder thing to say that about currencies. On a purchasing power parity basis, we can say that, but it can take a long time for those undervaluations and overvaluations to play out. But it's one of the positives for India. If we're investing in bonds, if we're investing in equities, the sense, the backdrop that we have of an undervalued currency as international investors gives us a great deal of comfort. So again, that's a positive for us.
Well, also 6 months back, India looked best on macros as well. The underlying macros were supporting the markets versus, some of its peers. Is that the case still? Do you still think that India looks like one of the stronger, more convincing macro stories as of now?
Well, that's a tricky question for me to answer because, as I said, that's not how we decide whether to invest or not in a market or in a sector or an economy. But I would say that the macro outlook for India has continued to improve. So if you think about all of the macro indicators that you can look at, and we've mentioned them all, so you look at growth, you look at inflation, you look at the current account deficit, you look at foreign exchange reserves, it's all improved in India. It's very difficult to argue that the macro has got worse rather than better in India. I think it's got much better.
Right, but then what explains the China story? The markets there have been on a tear after 3 years of underperformance. Growth is slowing. I mean, we just had the manufacturing activity reflect a third month of contraction. And monetary stimulus is supporting investment activity. Is it, again, a yield play, or are investors buying the transition in the economy?
Well, so I think there's a couple of points to make here. The first one is that I'm afraid you'd be mistaken if you thought that macro economic factors were highly correlated with equity markets. I'm afraid that's just not the case in China, in India, or anywhere else. Again, I know that's not an easy statement to make. It's not well understood, but look at China over the last 30 years. China has delivered an astounding rate of growth over the last 30 years, extremely consistently, and yet that's not the picture that you see when you look at Chinese equity markets. So I think the first thing we have to do is disconnect those two things. The second thing we need to say is that China was, and actually still is, one of the cheapest emerging markets in the world. On a profitability adjusted basis, it looks fantastic value, even after a very, very big rally, even after very strong performance last year and this year. So China has rallied off an extremely low base from a very, very cheap position. And I think the catalyst was the realization that international investors have probably been far too bearish about some of the structural issues in China. And once that realization dawned on people and people realized how cheap and how profitable many Chinese names were, we got this rally. And it also helped that the domestic investors felt the same, because to be clear, China is still a market that's very dominated by domestic investors. If we add up all of the quota that's available to international investors to invest in China, it's still a relatively small part of the market. So the domestic investor is very important. So that's the way we think about the Chinese rally. It was just a return of confidence and a realization of the very steep discount of that market to many other markets in the world.
Fair enough. Aside of all the cues that we've discussed, all the analysis that we've done about India, Asian markets, emerging markets in general, the most crucial cue for the markets world over would be what happens with the rates in the US. Most central banks are in easing mode at this point, including Japan and Europe. Doesn't it make it extremely hard then for the Federal Reserve to hike rates? Aren't there external and internal pressures that would perhaps lead to a further delay in the decision-making process?
Well, yeah, so I'd say probably that's not the best way to look at it, if I can put it that way. So I would say that, first of all, the US has been the engine of growth in the world, the only real engine of growth for the last few years. But that situation is changing because fairly unambiguously, the European economy seems to be coming online. And we now have, if we're a little bit optimistic about it, we can say we've got two engines of growth. And that's very positive. But I would say that the central banks around the world, including the Fed, are going to respond to the data. They're going to act according to the data. And what we expect is that the Fed will try to normalize rates as growth picks up, as growth becomes stronger, as wages start to grow, as the output gap in the US begins to close. And I don't think that that's changed. I don't think that that's any different today than it was at any other time in this cycle, or probably any other cycle. And I don't think in that sense their job is very difficult. I also don't, so the way we think about it is that in reality, therefore, for markets, we're in a very fragile equilibrium, if I can describe it that way. We've got prospective returns for all risk assets really very low. I doubt that the prospective return, the sort of future return of equities has been any lower in the last 50 or even 100 years. Now, that doesn't mean that equities are overvalued. It means they're appropriately valued relative to where bonds are trading today. If bond yields were to go up very suddenly, that probably wouldn't be very good for equities. It clearly wouldn't be very good for bonds either. But if we get a more gradual rise, and if that rise is a result of strong economic growth in the US, then that strong growth is actually very positive for equities, not just in the US, but globally. So we wouldn't be very pessimistic about it. I think we're in this fragile equilibrium, but actually the equilibrium can adjust, and even when the Fed begins to normalize the picture in the US, actually maybe equities can do quite well if, as we expect, that normalization is due to strong growth. So that's the way we would see it.
Right. The other key risk, of course, globally has been, the Greece situation. How much will a Greece fallout impact world markets? Should it be seen as a systemic risk? The reason I ask this is because the default risk has been high for a while, and the markets have been obsessed with talking about whether or not Greece will step out of the European Union. Do you think it would come as a shock if there is an official or a formal announcement to the effect?
Well, look, I think that the market has been dealing with this situation for quite a period of time. I think that the outlook for Europe is now much more positive than it was 12 months ago, 3 years ago, 5 years ago. As I said, the data that's beginning to come out of Europe indicates that the European economy is finally beginning to grow at a more positive rate of growth, probably still well below its sustainable trend rate of growth, but a much stronger rate of growth. So I think you've got to look at the situation in Greece in the context of that. And the institutions that have developed in Europe since the sovereign crisis initially hit 3 years ago, 4 years ago, these institutions are much stronger. So I think Europe is in a much better position all round to withstand whatever turns out in Greece. I think it's impossible for us to read the situation, to give a view as to what the outcome is going to be. It's far too complex. It's a political rather than an economic situation. And I'd say as investors, it's very, very, very hard to read. But I think we take a great deal of confidence in the strength of the European economy and the strength of its institutions.
And finally, Bill, before I let you go, as a CIO, where do you seek alpha opportunity in this market? Going into the second half of 2015, what goes up or down from here?
Well, I think that's a good question, and I think globally what we see is a very similar picture to what I was painting for India. We've got very expensive defensive names, very expensive pharma, consumer staples, IT names. And for us, they just don't represent very good value at this point. They're nice companies, they're good companies, but they've become very expensive, and as a result, they've lost a lot of their defensive qualities. So globally, whether it's in India or the rest of Asia or emerging market space, or even in developed markets like Europe and the US, we're much more attracted to cyclical names, consumer durables, financials, industrials. Energy and materials are also very cheap and quite profitable, but I think the read there is a little bit harder. So I think for decisive investors, for confident investors, there's a lot of good opportunities in those cyclical names. And that's certainly where we're hunting, and that's certainly the way that we want to construct our portfolios. And I think that's going to be a big driver of returns and alpha, as you put it, over the next 12 months.
Bill, thanks very much for taking out the time to speak with us and give us your perspective on the Indian market and world markets in general. Really appreciate your views.
Thank you.
With that, we come to the end of this edition of Modi 365, the FII View. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.